The broadcast is now starting. All attendees are in listen-only mode.
My name is Kevin Apker. I'm the chairman of Avondale Corporate. We help people buy and sell companies. We specialise in the SME space, small and mid-size. There's companies with a value of between 750,000 and 50 million. Typically we do about 25 deals a year and we've got a team of 20 odd people. Today's webcast is on maximising value and when to sell. The first thing we need to do is look at the backdrop that we're facing at the moment, and in particular some of you will be wondering what's happened since Brexit. Brexit caused quite a few of our transactions to slow up. We had a period of uncertainty at the beginning of the year where people were going, well, what's going to happen? And our pipeline actually started to back up a little bit. The good news is since the vote to exit, the majority of those deals have gone through. We've had one that's been reviewed by a credit committee as a result of the Brexit from the bank. So it looks like it's going to be business as usual. Indeed, after the event, we had the majority of private equity firms that we deal with, and there's over 2 billion in London waiting to be invested in the mid-tier space at the moment, phoning us up and saying we're still very much open for business and we're looking to do deals. So it looks like the Brexit impact is going to be fairly minimal to mergers and acquisitions in the short and medium term. There is a view that the decision to Brexit will actually slow the UK economy, and if we look at the underlying trend in terms of mergers and acquisitions, what's actually happening out there is that people are buying companies as a result of that slow growth. The slow economy makes mergers and acquisitions more attractive, not less. If you think about it, if you've got strong organic growth, then there's less need to look at deals to create shareholder value. If you've got slow growth, then there are too many companies doing the same thing, then you need to see consolidation to make more effective companies. So we see the mergers and acquisitions market actually growing stronger under this current period of uncertainty. As far as also we've seen, and obviously bear in mind we're in the front line from the point of view of deals, we've seen an awful lot of uncertainty since 2009. So our mindset is very much uncertainty is the new certainty for business owners. And so we need to see that the way of creating shareholder value of growing organisations is around bringing them together and bringing organisation restructures into business. And that's increasing mergers and acquisitions activity. The overall backdrop, as I say, is slow growth. If we look in 2008-9, we had a 5% drop in GDP. We've come back. We're back to and have increased from 2008-9. We've had growth. We're back, but we're about 5 years behind on the cycle. And fundamentally, that's because Western economies, advanced economies, are slowing down against the rest of the world. And again, that's slow growth, which is driving M&A activity. And the biggest reason for that is a demographic one. We're all living longer. The world population has grown from 2 billion to 7 billion people in 60 years. An awful lot of that is in the West. And the average life expectancy is growing by 2 years for every 10 years that people are living, which is extraordinary. So a very, very aging demographic, further adding to slow growth economy. So the backdrop is lots of mergers and acquisitions activity, but who's buying and who's selling? And of course we've got the underlying question of when to sell. Well, we're going to tackle that later on. But most of our sellers are people who historically would have looked at family succession. Family succession has significantly reduced. In 1980, something like 75% of businesses changed hands through family succession. Through our research at the moment, something like 5%. So it's a significant reduction. So this causes a succession issue for most sellers. And probably the reason behind that, sons and daughters of entrepreneurs, well educated, they want to make their own path. Also, mum and dad are looking to, all they've ever done is moan about the business, so their kids don't want to take it over. And the further point behind that is mum and dad need to capitalise on their assets. MBOs still occur, very reasonable way of changing hands and creating a transaction, but there is a issue behind MBOs, and that is lack of bank support. The banks are not lending as much as they used to in terms of ratio of loan to value, and as a consequence it means MBOs are hard to get away. But overall, most of our sellers are selling in order to achieve capital certainty. And they're normally at a crossroads. They can see that the business is perhaps slowing or is facing the next cycle of investment, and for them personally, they feel that they may not be the right people to take it to the next level. And therefore, selling the company creates capital certainty against that backdrop for them. Having said that, the one thing that we're also seeing is a very significant reduction in the retirement seller. Most of our sellers, yes, they want the capital, but they no longer retire. Again, we'll talk about that later. As far as buyers are concerned, if we've got all these sellers, who are the buyers? Well, an awful lot of the buyers are also themselves in the future looking to sell. We're looking at buy, build and sell strategies, a significant part of our buyer base. And again, this is this backdrop of organic growth is slow, buying and consolidating companies is a fast way to create shareholder value. You create shareholder value, that's where the wealth is, with all the tax breaks. When you sell a company, then that makes a more logical story as far as acquiring is concerned. The other thing is, interest rates are very low, so the cost of funding transactions is very affordable, and there is limited yield elsewhere. If we look at money, and we look at investment yield, typically investment yields in the FTSE, 5-6%, small and medium-sized businesses, you might expect between 15 and 25% yield. So people are very, very interested in buying companies and growing them, partly because of the tax rates, partly because they actually offer a significant yield. Most of our buyers are looking for what I call a 1 + 1 + 1 = 6 equation. The logic behind the acquisition is it's not good enough just to have economies of scale, although that's the first one. You need to have also synergy, the ability to cross-sell products. That's the second one. And then the third one is shareholder value. And if you get all three of those in alignment when you acquire a company, that's the true route to wealth. So 1 + 1 + 1 = 6. Economies of scale, synergy, shareholder value, and that's the alchemy behind doing deals. So most of our buyers are themselves at some point looking to cash in on a shareholder value play later on. So of course, with this merger and acquisition backdrop, buyers and sellers, we all need to understand how do people value businesses. We've covered this before in other conferences and webinars, so I'm going to whiz through this today. There are lots of different valuation methods, but the most important one in the SME space is the PE multiple method. And typically, a PE is a multiple of the adjusted sustainable profits. More and more we're doing transactions on current run rate. So historically, the mindset used to be it was the last 3 years average profits. Well, increasingly, people are very focused on what's happening next year and the year after, as opposed to what happened 3 years ago. Also, the profits 3 years ago have been spent. Tomorrow's goodwill is what it's going to do tomorrow. So valuations are much more being carried out on the current real-time profit and against the forecast, as opposed to just the history, and that's important. Debt-free, cash-free is on the assumption that most companies are share, or most deals are share deals, so the balance sheet will transfer with the transaction. So we need to look at what balance sheet is included in the deal. The accounting definition of goodwill is the difference between the price paid and the net asset value. So clearly, if you sell with a low net asset value and a higher price, you've got more goodwill. How do we work out what's a low net asset value? That's where we do this debt-free, cash-free calculation. It shows what the surplus cash or the fat might be in a business. So price earning multiples, typically of current and future forecasts on a sustainable basis, including the balance sheet, but debt-free, cash-free is the typical method. Here's a slide that shows you how that works in real time. So we've got multiple down the side on the left-hand axis, which is also a number of years' earnings. We've also got EBITDA or PBIT across the top. So that's profit before interest and tax, or earnings before interest, tax, depreciation and amortization. And we're running the profit range from 250,000 up to 12 million, which is the range that we typically operate in. And you can see the gold area is where we like to think that we're creating transactions of strategic value, and the dark brown is where you've got the typical accountancy valuation. Accountants can value businesses, but of course it's actually only on the day of completion that we know the true value, and after that it's changed anyway. So, valuations are only a forecast. It's only on the day of completion, assuming a willing buyer, willing seller, do we truly know the value. But you can see here that typically the multiple range in the SME space is between 4 and 8, and possibly at the high range of profit moving to 10, 11s. And the reason the bigger the profits, the bigger the multiple, is invariably the bigger the profits, the bigger the infrastructure, the more economies of scale there are in the business. Also, the higher the quality of earnings. And the other element to that is also the deeper the buyer's pockets. Bigger companies will only appeal to bigger companies. They themselves are trading at higher multiples. So, fundamental rule of price-earnings ratios is the higher the profits, the higher the multiple, typically. And the other biggest influencer to multiple is the forecastability of the profits. The more recurring the profits, the more likely you are to get a higher multiple. And so the strategic value is where you're breaking the rule book as far as the typical multiples that might apply. But you can see here, if we had a business with £1 million EBITDA, a multiple of 5 or 6, you might value that at 5 or 6, debt-free, cash-free. EBITDA we use for service businesses, PBIT, where depreciation is a real cost, CapEx is a real cost, would tend to be more for manufacturing type businesses. So it again depends on the business model in terms of which one you might use for valuation. We've got an example here. This was a medical clinic we did last year. The balance sheet had a bit of a debt-free, cash-free. Actually, when we did that maths, we looked at the cash versus the debt. Because they'd had a high amount of capital equipment investment, they actually had quite a lot of debt. So the ratio wasn't good, and actually we had a minus number. So when we got the deal value, we then had to put 25 grand back in to create that. Debt is inland revenue, tax, HP, bank finance. It's not trade debt. Cash, of course, is cash. So we adjusted the balance sheet. We also adjusted the profit and loss. We had a business with an operating profit of 438,000. For various reasons, they weren't paying the full rent. We also had 2 directors, one of which was part-time. He had a strategic role. He wasn't fully involved in the business day-to-day. So we added back his salary. And you can see there, when we did adjustments, we ended up with a profit of 520,000. We did a valuation and suggested the multiple for a medical clinic would be around 5.5 times, so 2.86 million. We actually got 2 bids on this business and achieved a deal value of 4 million. So well in excess of the forecast. And that happens. An awful lot of that happens around deal structure, and again that's relevant to timing and when to sell. In this case with the medical clinic, our clients are still working in the business a year on, and they've got another year to go. So typically when you're selling a business, you need to load in how long you're likely to have to give a handover and how long the buyer is likely to need you. And that actually depends on how hands-on you are in terms of running the business. Again, we'll look at that later on. But the biggest reason that we got 4 million when the valuation was 2.75 was around the deal structure. The business was growing. Yes, we had an adjusted profit of 530, 540, but we forecasted forward that we were going to hit 600, 700. We had a run rate to demonstrate that. So as long as we hit those numbers, we will get an earn-out on the growth. So it is actually the same multiple, but it's a multiple of the next 2 years' profits. We also took a deferred payment, which helped the buyers fund the deal, and hence you've got a £4 million deal value. So interestingly, when people talk about the multiples they got when selling a business, the problem you've got here in understanding what that really means is unless you know the deal structure, you can't judge it. The more deferred the deal structure, the higher the potential, or the higher the potential multiple could be. because they lower the risk for the buyer. So that sums up some summary of the position for a strategic transaction as opposed to a financial transaction. Two bids, competitive environment also influences the value, so the process you undertake when selling a business is also critical in terms of assessing the value. Also the preparation and the positioning that's taken. So we don't go out without thinking about the position in the market, and selling against forecasts is quite a critical element to the equation. Here's some other strategic transactions. And again, we need to look at timing and why people are doing transactions against these deals, because it's an important part of mergers and acquisitions. Obviously, you need to get your positioning right, but you need to judge when the market is right for that acquisition, and you need to look at when's right for the company. It's an important equation. So, but a few examples here. We had an IT business with a profit of 300,000, 1.5 million pound revenue, 20% ROI, a straight flat PE of 5. And that went to an IT consolidator. They'd already bought two companies. They are hoping to sell out themselves on a multiple of 8 by bringing together lots of smaller companies and bolting them together. Why did our man Andrew sell that transaction? He had tried to grow it himself, and he'd actually tried to be a consolidator himself. He'd looked at doing acquisitions, couldn't quite find the right fit. The risk that he was looking at, he was quite conservative, didn't quite steel himself to take the risk. He'd also tried organic growth, various different business development models, and was finding that contracted recurring revenue in the IT space is very, very, very sticky. So organic growth wasn't working for him. Acquisitions, his risk profile wasn't right for it. Conclusion, I'm not the right man to take this business forward. Time to go off and do other things. I'm a cash in. Delos Creative, a different transaction. That was a care business looking after people with special needs. 300,000 profit, not very strong profit on its turnover. Exceptional business, very good ethos, very good values. Went for a £3 million transaction, and that was a very, very big price. That's very, very strong multiple. Why? Bought by a housing association. They had the housing stock to do a significant scale up. The special needs people were living in these houses, and you need stock in order to scale up the business model, which is expensive. Our client didn't have that. But the other reason our client didn't have that is she was 70. She wasn't involved in the business day in, day out. Very sprightly 70, I should suggest. She was doing a politics degree at university as well. But she decided that it was time to move on. Interestingly, one of her daughters was in the business, but the conclusion was it was too big and her skill set was not entrepreneurial enough to take the business to the next level. So that led to some interesting discussions with the buyer. I won't cover all of these, but just to sort of finish on this, the final transaction, Updata, 80 million, it's a transaction that we knew the people quite well on, 5.6 million profit, 80 million, again, a very, very strong multiple on that business. And simply because the forecasts on their recurring revenue were taking the profits to well in excess of 10 million. It was highly contracted, sticky, recurring revenue, and that's important if you want to get a very high multiple. They had contracted revenue, forecasting income over 3, 4, 5 plus years in the lease space that they were operating. The guy selling that had taken in private equity 2-3 years previously, which had helped them scale the business up before. The decision to sell was as much the private equity looking to cash in as it was our guys who were mid-40s. And actually, also the decision to sell was lifestyle orientated. So the main seller, there was a number of them. The main seller has bought a manor house in Devon and is doing country home rentals. So very much a lifestyle decision behind that deal. Timing, they had got it as far as they were going to go on that cycle. They either needed to take in another private equity player or go into a substantial corporate. And it was Capital that completed that deal. So we can see here on timing and when to sell and why sell the business stage has as much as an influence as the personal stage. The traditional viewpoint was you sold your business when you came to retirement. That is no longer the case. People are increasingly looking at the cycle of their business and using that to drive the decision. And actually that's good business sense. We do meet many sellers who have let their own personal circumstance influence the decision as to when to sell. And the typical one, I'm afraid, is ego-driven. They like the business, they're not objective about it, they enjoy going in, and they don't like the idea of not doing anything, so they keep going even though the business may have plateaued or be facing the next cycle of investment. So they're not objective enough about the business stages. So clearly when a business is growing, that is an exciting time for business owners. But this question of when to sell tends to come up as a business starts to plateau. Now plateaus occur for all sorts of reasons. It may be a lack of capital, it may be the risk profile of the shareholders, it may also simply be the marketplace, new product, easy to establish, focus, get it in the marketplace, other people start coming in and copying, the marketplace gets harder, gets stronger. So invariably businesses at some point or other will reach a plateau. So by plateau that means growth is starting to flatten out. And when you face that reality, that's when you need to step back and be objective about, am I the right person to take this business? Are we the right team to take this business to the next level? What is the next level? And interestingly, the plateau we see most, I call cultural to commercial. So in the SME space, that's where the business has been driven by the entrepreneur shareholders. They've got 50, 60 people, they've done very well. The business is starting to move into the more corporate commercial, but they haven't really got the skill set to become that political corporate manager as opposed to the entrepreneur. They start getting frustrated, they don't put in enough systems, too many of the arrows in the business point to them, they're too hands-on, not hands-off enough, and as a consequence the business starts to plateau. And typically that's because entrepreneur shareholders and second-tier management, the quality of second-tier management is often weak because the entrepreneur managers don't allow them the space to drive and grow the business. And so there's a wrestle, there's a conflict that goes on there. So when you see that going on in the business, people are trying to grow, they're failing, then they go, okay, do we need to reinvest? Do we need to look at the people, or am I a seller? And that is a typical trigger for a sale as opposed to retirement. Now, of course, the choice there is, do we invest? And actually, we do now have a number of sellers who are on that mindset. Because of our processes and systems, we've got a very refined process that, certainly in terms of exploring the market, reduces the time involved for sellers, which enables them to be looking at a dual-fold strategy. So strategy might be, we'll do an M&A if the price is right, and indeed an exit if the price is right, if we can maximise that. Alternatively, we'll keep the business and we'll take the business to the next level, and it will only get more expensive. Now the good news is, of course, that creates leverage in the marketplace. So for buyers looking at that business, they may have their own view of value, which might be the more financial value, but the strategic perspective is, if these guys do deliver on their growth plan, they're only going to get bigger, it's going to get more expensive, now is the time. So it can create leverage in a transaction. And by investment, typically the major area of investment to break through plateau is creating an environment where the shareholders move from management to leadership, and they bring in second-tier management to drive the business. And that's a skill, and we'll examine that ourselves in a second. So this is a slide that sort of brings together that when to sell motivation. So they're at a crossroads. Typically there's a plateau or growth is slowing. They start reflecting, am I the right person, either for age or skill set to take the business further forward. You then look at your own personal situation, so what would I do? Big question, what would I do? Most of our sellers, as I suggest, do not retire today. They're not going off to Spain, and the gin and tonic lifestyle has reduced. Most of our sellers have what I call a portfolio career, and they are typically investing in smaller companies, doing a bit of business consultancy, and usually you find a bit of property work behind. Of course, some are serial entrepreneurs, and that's a very exciting business as well, but it's not typically for retirement. They're looking at the other side of the equation. Am I the right person to take the business forward? Am I an entrepreneur as opposed to a corporate manager? And can I really make that change? My skill set is building and growing companies and being inventive and thinking about new products. Am I the right person to start running a corporate commercial entity? And can I, if I'm not, bring in a team to do that for me and or indeed let go? And do we have the depth of pockets to do that? One of the biggest failings that we see in a lot of the companies we're looking at is they bring in second-tier management and either they don't pay enough or they don't make the job role clear enough, and as a result it fails. On the other side, therefore, they'll be looking at, well, okay, so if we're not the right people to keep the business, what are our options to sell it? Is it a trade deal? Is it a flotation? Do we do a management buyout? How do we deal with this whole succession issue? And there's a new element to us as well, which is elevator deals. Now, we're doing more and more elevator deals. Elevator deals are where you take in investment or a trade deal and you sell out the majority, say 75%, but you keep 25, 30% of the business. That gives you a second bite of the cherry. That's very good for entrepreneurs that are capable of fast-tracking the business, because the corporate trade buyer that's bought the majority of it would tend to look after the corporate governance side, all the HR, the accounting, all the bits that typically shareholder entrepreneurs are not good at, and they can go back to doing what they were good at, product development, looking for deals. So it can be a really strong way of finding a mid option. So you do a majority sell out, but you keep some skin in the game and get a second bite of the cherry, hopefully over the next 5 years. Can we make that 30% worth another £10 million? That's usually the question when we're looking at elevator deals. And then, of course, the other element is, well, what's happening actually out in the marketplace? What is our mindset as shareholders? What's the opportunity for growth? I was with a company yesterday that has been growing at something like 30-40% a year and is facing the second-tier management question and deciding, are they going to sell versus keep it and take it to the next level? Hadn't fully articulated in his head the strength of second tier that he would need in order to do that. But the other biggest issue is they hadn't mapped out how big the market was. So they knew they were growing, but the question was, did they have 10% of the market, 20% of the market, and how much more could they reasonably expect to get in that sector? So when you're deciding, should I sell, should I buy, should I stay, should I go, understanding the opportunity in front of you is also very critical. There was a chap called Mark Dixon, I don't know if you remember the name, but set up a business called Regis. He sold his printing company for 1.5 million. The opportunity he had for his new idea in service offices was far greater than his business in printing. So although his business in printing at the time was quite successful, the decision was the new opportunity has a higher return on investment. I think that's proved to be a very good decision. We also work with a client, I believe he's called Britain's richest dentist now. We're estimating the wealth is around 80 to 100 million. He sold his dental practice for 2 million. He's buying all sorts of commercial companies at the moment, built a private family office. Again, opportunity is greater than being a dentist. So that's an important element. Also, how is the market viewing your business? Are you considered sexy at the moment? Therefore, will you get a higher multiple? Are people very acquisitive in the space? So timing is always going to be critical when you're looking at this equation. Again, the backdrop we're facing is the market is highly acquisitive. And actually, multiples have been slightly pushing up, simply because there's so much money in the marketplace looking for a home. I mentioned earlier there's over 2 billion in private equity looking to be investing in the small to medium-sized business space. And that's because of limited yields elsewhere. So fundamentally, this question of buying and selling, how much am I worth, what is the right time to look at this equation? The key behind it is being objective. Get a valuation. It's the start to the question. What are we likely to be worth today Valuation will only be a forecast, it will only be an opinion, but it enables you to make decisions about it. Step back and look at the business design. What are our multiple influences? How can we make the business more valuable? And that's a critical question. A really good question that we often throw at boards is how much time do you spend asking the question, how do you make your business more valuable, as opposed to how do we make more profit? The vast majority of businesses are managing for the moment and they're looking only at that profit question. The biggest fundamental influencer to value is recurring revenue streams. So again, the client I was with yesterday to share the story, but we were looking at his business model. It's fairly dependent on him. So that's not that sustainable. So if you look at that, you would say, well, yes, it's got good recurring revenue, but it's quite dependent on you, and therefore that would impact on the multiple, because people would go, well, how do we replace you? Yes, we can lock you in when we do a deal, but that increases the risk of the deal. The other element might be contracted recurring revenue. A classic valuation influencer, if you were valuing an estate agency, you're only as good as the last houses you've sold and the current construction portfolio. So that would be typically a low multiple or a lower multiple. If you've got a strong tenants agency, a lettings agency, then it's lots of transactions, lots of recurring revenue, lots of small but ongoing contracted income. So that would tend to go for a much higher multiple. So the question, if you were in an estate agency or letting agency, which product should you concentrate on in order to influence your value, then it would always be the letting as opposed to the sales side of the business. And that's what I mean by business design. It's about stepping back and looking at where your business is more objectively, understanding that it's not all about profit, it's about quality of income, sustainability of income, recurring levels of income, but also team-driven, with a second-tier management that are capable of taking the business to the next level. And the overall context of that, we're looking at this question, how do we take the business to the next level? How do we make it more valuable? Are we the right people? Is it time to sell? Is the design of the business and how the market perceives that. And fundamentally, around this question of why are you better? If you are the same as everybody else in the marketplace, then they will have other businesses that have a comparable to buy. So of course, rarity impacts on multiple. The rarer you are, the more likely you are to get a higher value. The more niche you are, the higher value. And if you stand out as being ahead of the market rather than behind the market, again, you're likely to get a higher value. And so you're looking at the positioning of the business and actually being able to communicate why you are really better can influence multiple. But also it can influence growth. When you look at most companies and you ask them why they're better, invariably the answer in the end is normally, well, it's our people. But everybody says that. So it's not a unique selling point. So we really need to look at this question because it's compelling for people that are looking at acquiring you. It's also compelling for your customers. So to start looking at, if you want to keep the business design, if you want to enhance the value of the business design, as business leaders, we need to move from management to leadership. Management is where you ask whether Fred is any good at his job, and the majority of what I call board meetings tend to fall into management. They very often have a bad habit. It's too much of a focus. We know Fred probably isn't good at his job, and we've been asking the same question for 5 years, so maybe it's time to do something about it. Leadership is what's happening in my marketplace. Who else is doing what? How are they doing it better? How can we do it better than them? What new products, territories, strategic alliances and acquisitions do we need to do that will take us further ahead of those businesses? And if you're looking at growing a business, looking at the key time of the key leaders or key shareholders or key managers, where they are focusing will be absolutely critical to this question of how you drive growth. Invariably, when you do that time log, they are spending 3-4 days a week on management, not leadership. Leadership is the strategy side of the business. Looking further ahead and understanding where you can take it and what the multiple influences are. And in that context, we also need to look at creating businesses which are team and market driven. So where we create a situation where we're hands off and our team are doing the heavy lifting and driving or running the business day to day, whilst we look for the opportunities elsewhere. And that's when you end up with more valuable companies. This is all about skill set. So we come back to this timing question of when is right for you to sell. And ultimately, there's a shareholder alignment question. Very often you get businesses with multiple shareholders who are also executives of the team, and they're asking this question, when is the right time to sell? That depends how much money they're going to get out of it. It also depends on their personal ambitions, and often that also depends on age profile. The one thing that we like to do to hold the mirror up is get people to think about the equation net of tax. So very often the thinking goes along the lines of, well, we're earning £500,000 a year, if we sold that for £3 million, we could have that in 5 years. Well, that's not true. £500,000, typically the tax on that, corporation tax or dividend tax, would be around the 50% mark. So £500,000 is actually only £250,000 a year that you can put in your back pocket. Whereas if you sold that business for £3 million, then you would only be paying tax under the current regime of entrepreneurs relief at 10%. So that would mean that it's more like 7-8 years earnings. And that ignores the yield you would then get from capital. So we mentioned earlier, if you invest capital, you would typically expect to get 5+% from that capital. So there's an objective equation around the value of capital versus the net present value of your current income. And if you start looking at that equation, often it can help bring shareholder alignment. So again, whilst we're looking at this question, we find a lot of companies where you've got one person that's very clear they'd sell for this price, you've got another person that's like, no, we need to take the business to being worth 30 million before I even look at it. And it depends on aspirations and ambitions, but it's quite an important area. And again, when we look at board meetings and strategy, very rarely has there been enough dialogue to get people on the same page as far as that shareholder alignment is concerned. And it can be very critical. But obviously, if you feel that the value of the business is not enough, then the biggest option you've got is to make it more valuable. And that probably means reinvesting in the business, and it probably means choosing to stay for the next 5-year cycle. If, however, you've looked at that equation and you go, no, capital is better than income, we are sellers, we're very clear we want to maximise out, then of course we still have to look at the process of how we then do maximisation. The key there is around being prepared. The better the data room, the better the forecast, the better the management information systems, the higher the quality of the infrastructure of the business, the better the value. Use a good advisor. Of course, with us, we'll say us. We will create an auction. That's a competitive environment. Our average project today gets between 3 and 4 offers. That will also further influence the value. Get the right deal structure. Again, we looked at that earlier. If you get the right earn-out or the right elevator deal, then you may get a second bite of the cherry. And ultimately, the answer to the question lies in what's your journey. We want to get a maximised price, a maximised competitive environment, an auction going to get top dollar. A good advisor will deliver that. But behind that question, a good advisor will bring out that question from you. What is your journey? And it's about holding the mirror up and understanding objectively where you truly are. That's a bit of a whirlwind. I hope it was useful. Thanks for listening.